Welcome to our October quarterly market update from John Giordani, the Chief Investment Officer at Planning Solutions Group. Given the recent market correction, this presentation is going to run a little bit longer than our normal quarterly updates. Our theme coming into 2018 was making volatility great again, and this year sure hasn't disappointed. Investors have been caught in a tug-of-war between positive fundamentals of a good economy with above-average earnings growth aided by tax reform, countered by the risks of an escalating trade war with China, rising interest rates, and valuations. October sell-off has markets registering levels of extreme fear, as shown here by the CNN Greed and Fear Index. Remember, emotions drive market prices in the near term. And just a month ago, as U.S. stocks approached record high prices, we were at the opposite end of the spectrum, same as a year ago when it became apparent tax reform was a done deal. Quite often, investors want to buy when it feels good and sell when it doesn't, and this is a recipe for disappointment. Don't let emotions impact your investment decisions. Instead, stick to your plan, focus on the fundamentals, and follow time-tested principles of investing. Remember, there's always a reason to sell. This chart is from Ritholtz Wealth Management. You can pause the presentation and read through all of the negative headlines over the past several years. Each one scary in its own right, as Mr. Market was trying to make you abandon your investment plan. The line that is up and to the right is that of the U.S. stock market. Notice the volatility of U.S. stock prices as you move from left to right. Had you sold on any of the headlines because it felt bad at the time, you missed out on gains later on down the road. We recently sent this chart out to you from JP Morgan Asset Management. Pullbacks in stock prices are normal. A 2% correction happens on average 18 times per year, and a 5% decline on average occurs 4 times per year. Guess what? This recent 5% pullback is the third of 2018, so we're pretty much right on track. In fact, as reported by Pension Partners, there have been 23 total stock market corrections of greater than 5% since March of 2009. The average correction lasted 42 days and saw a decline of 9.3%. What we are going through right now, I know it feels scary, but try and keep your emotions in check. All of this negative news has left investors feeling pretty frustrated. Year-to-date returns are minimal, with most asset classes in the red, including international stocks and bonds. For U.S. stocks, Amazon and Apple have too recently pulled back, but still are up significantly year-to-date, and this has helped U.S. stocks weather the storm. In fact, the average stock in the S&P 500 is down 17% from its 52-week high. With international stocks and bonds turning in negative performance so far this year, many investors are asking if they should just abandon the asset classes. When asked why, the answer is because the prices are going down. So let's take a look at, is diversification broken, or investors letting the news and feelings creep into their heads? First, let's start with bonds. Historically, bonds have helped balance an investor's stock exposure by protecting against significant losses. Take a look at this chart. These are the years that U.S. stocks lost money. In blue is the negative performance of stock during the specific year. In green are bond market returns in those same years. Notice in the 21 calendar years where stocks lost money, bonds were positive in all but a couple of the years. Now, zooming in on the last 20 years, bonds have outperformed U.S. stocks 6 times. Bonds dampen volatility. Yes, bonds can lose money, but a bond bear market is a loss of less than 5%. And compare this to stocks that have seen 2 different bear markets with losses of more than 40% since 2000. Investors were happy to have some safety assets when stocks took it on the chin. Many of you have also seen this chart from GMO, but it's important to revisit. The chart looks at relative performance of U.S. stocks versus international stocks. Periods in orange are where U.S. stocks are doing better than international stocks. Conversely, periods in blue are those where international stocks are doing better than U.S. stocks. At the top, the magnitude of outperformance is listed. Some takeaways. Asset classes perform differently over various time periods. Over the past 45 years, U.S. stocks have led in 4 of these periods, while international have led in 3. But guess what? Over the entire data set, total performance between the two is not that different. Now, if you have a long-term horizon, you need to own both since market timing does not work and it's hard to predict when one is going to outperform the other. Looking at the last 20 calendar years, international stocks have outperformed U.S. stocks in 10 of these years. Lastly, let's just take a look at emerging market stocks. These are stocks from countries in South America, India, Asia, and Eastern Europe, to name a few. The column labeled MSCI EM is the performance of emerging market stocks in different time periods as compared to the performance of U.S. stocks in the S&P 500 index, which is listed in the last column. Notice in each period the significant difference in performance between the two asset classes. There are times where you're much happier owning one over the other. But now look at the last row. Long-term performance is pretty close. Again, unless you're a great market timer and can predict future performance, it pays to diversify and own both. Let's switch gears now away from behavior and look at fundamentals. We believe they should help support a pro-growth stance. Does this mean prices for assets like stocks have to go up? Not at all. But we think that the current environment will help contain the downside. What usually blows up risky assets like stocks is a recession, and we just don't see one of them on the near-term horizon. Corporate tax reform in the United States, along with the spending bill, has the U.S. economy humming along. Here are the leading indicators for our economy. Notice up and to the right. In fact, near record highs. The shaded areas in 2001 and 2008 are the last recessions. Notice leading indicators were rolling over and headed down prior to the recession. A list of categories that constitute leading indicators are listed to the left of the chart. Looking around the globe, the environment is definitely not as strong as last year, where a rising tide lifted all boats. We are seeing some cooling. Trade jitters and stress in some areas of the world have negatively impacted growth. The International Monetary Fund still sees economic growth of 3.7% this year and in 2019 as well. How about corporate earnings? Estimates for next year for the U.S. are in blue, international stocks in red, and emerging market stocks in green. Earnings growth will slow down versus the double-digit growth rates of the past 18 months, but still should lend support to stock prices. Now, just because earnings are positive, again, doesn't mean stock prices have to go up. Take, for instance, this year. If you would have told me that U.S. earnings are likely going to be up more than 20% versus last, but U.S. stocks are barely up for the year, I would never believe it. We do think earnings growth will lend support to stock prices, and as I mentioned before, limit the downside. Lastly, given this backdrop, valuations are not too far out of whack. U.S. stocks are only slightly above long-term forward price to earnings multiples. Overseas markets offer more value, but are also deemed more risky. Most investors right now are focused on the bad news overseas, whether it be China and trade, Brexit, Italian politics, or geopolitical events in the Middle East. Hence the big difference in valuations versus U.S. stocks, as U.S. markets are seen as safe havens. International stocks, as shown in red, trade at a discount compared to both their long-term average valuation and are more than 20% cheaper versus U.S. stocks. And emerging market stocks sell at a 35% discount to U.S. stocks. Some valuation firms have made the call to hold your nose and buy international markets as they believe they are too cheap to ignore. Speaking of emerging market stocks, we recently reviewed the Brookings Institute's study on middle-class demographics. Shown here are the spending estimates by consumers in developed markets like North America and Europe, and emerging market areas like the Asia-Pacific region. It is not the easiest to read, so let me just summarize the conclusions that are highlighted above and below the picture. Brookings estimates that by 2030, middle class consumption will grow by $29 trillion across the globe. But only $1 trillion of that growth will come from developed markets like here in the US and Europe. So where's the growth spending coming from? How about Asia? They estimate that the Asian middle class will grow by 250% to 3.6 billion people and spend 18 trillion more than 2015. This demographic tailwind is an interesting investment theme, but it's a volatile asset class, and before investing, please consult with your advisor. Now let's take a look at some of the key risks that investors are focused on. Front and center remains the potential trade war with China. We have discussed this at length in previous communications, and the longer it drags on, the greater the risk to the economy and markets. Until we see a positive development out of this ugly situation, expect markets to continue to be volatile. Other risks include rising interest rates, which have reared their ugly heads, and we also have some information on midterm elections. The Federal Reserve continues to raise short-term interest rates. We have seen 8 interest rate hikes since December of 2015. The Fed is slowly taking away the punch bowl. Notice the chart that is the history of the federal funds rate that the Federal Reserve controls. The gray area is a recession. In every case since World War II, prior to the onset of the recession, the Fed was raising rates. So if the past is a guide, the Fed will overdo it, tighten too much, and a recession will result. However, this may take several years to develop. Historically, recessions lead to much lower prices for stocks. Now, the good news out of this is that for savers and bond investors, shorter-term, safer investments are now available that earn 2% or more. This looks pretty good since cash has been earning close to zero for the past 10 years. The 10-year Treasury bond also has increased in yield from 1.4% in June of 2016 to well over 3% now. This has been a headwind for bonds over the past 2 years, and the main reason that certain bond subsectors have been in a bear market. But let's look forward, and it's a more positive outlook. Savers are getting a pay raise, and we believe bonds will positively contribute to portfolios beginning in 2019. Lastly, let's take a look at the upcoming elections here in the U.S. Historically, it's pretty volatile during midterm election years, just like this year. However, as shown here, the returns in the 12-month period after the midterm elections have been positive. Notice in that 17 of 17 occurrences, stocks have registered a positive return. Right now, the odd makers have the Democrats taking control of the House, and it'll be a long shot for them to win the Senate as well. If they win both houses, markets may not like this. Investors could believe that the current pro-business agenda is doomed going forward. Gridlock isn't the end of the world. And as we preached before, most importantly, don't let your politics influence your investment decisions. So where does that leave us with the portfolio? We highlighted that given the risks, how important that diversifying your portfolio is. The U.S. is likely in late cycle stages where owning high quality blue chip companies that pay dividends is favored over speculative companies. We also showed that international stocks, while contrarian and facing several issues of their own, should not be ignored and included in the asset mix. Don't be a hero. Have safety as well as growth-based assets. Defense helps in uncertain times. And lastly, rebalance by taking gains in assets that have done very well and buying those that haven't, and realign your portfolio with your risk tolerance. In addition, in taxable accounts, take losses to offset future gains or use it as a deduction against current income. Thank you for listening to our current market update. Corrections are no fun, but please, if you have any questions, feel free to contact us. You may also access more information, including timely articles and account information, by visiting our homepage. Please watch for another market update later this year. Thank you.